Thank you. Good afternoon, everyone. Welcome back from lunch. I hope you're enjoying the conference. So I'm Priyanka Shukla, and I'm thrilled to moderate the fixed income panel today. As you all heard, the Fed cut interest rates by 25 bips yesterday. The US dollar has been down almost 10% year to date. Emerging market local debt has been having great returns. I know there's been lots of renewed opportunities in securitized, CLOs, and credit, so there's plenty for us to discuss. The way we'll look at this is we'll start with the big picture, that's the macro backdrop, and then we'll dive deeper into emerging markets, credit, securitized, and we have an intimate group. We'll wrap up with your questions, so you'll have an opportunity to ask our expert panelists some questions as well. So I'm joined by a fantastic panel here, and people from Payden, Loomis, and TCW. Together, the firms manage hundreds of billions of dollars in fixed income assets, so we are very lucky to have them here today. Let's start with brief introductions. So the panelists will provide a brief introduction, and I'm also going to ask them to share something that's surprised them, perhaps a recent piece of market data or something else that was genuinely surprising. And audience, please keep track of this as the panelists talk about it, because we'll circle back to it later. It's not a test, but it'll be good if you keep track of it. So you want to lead us off, Kristen?
Can you hear me? I'm Kristen Seva, and I head up emerging markets fixed income strategies at Payden. And I think the surprising market development for me recently would have been the significant win by Malays Party in the recent elections that we had for Congress in Argentina.
I'm Brian Kennedy, I'm portfolio manager at Loomis Sales. We manage a basket of multi-sector flexible strategies on the fixed income side. I think the piece of data I've been most surprised at recently is just the market, the yield curve reaction to the lower jobs creation data in the U.S. here. I just feel like we could talk about it a little bit later, but there's some pretty significant, I think, justifications for the lower job growth, and so talk about that in a little bit.
Hi, I'm Anisha Goodley. I co-lead the fixed income portfolio specialist team at TCW, which is headquartered right here in downtown LA, around $200 billion of assets under management, of which the core is fixed income. And then in terms of data, and we'll get into this later, I think there are two things. One, inflation has been relatively calm in the face of tariffs, and then just picking up off of what Kristen mentioned, just broadly the resilience in emerging markets and some of the opportunities that have arisen there.
Looking forward to hearing about the surprise, but let's start with the macro. So the US dollar has weakened significantly this year, as you all know. And how is that shaping or reshaping the global fixed income landscape? And then as a follow-up, whenever you'd like to address it, do you think this is structural or more cyclical? Brian, you want to lead us off?
Yeah, I think it's both structural and cyclical. We've had a secular view for quite some time with something we call the 4Ds, deglobalization, decarbonization of economies, demographics, and deficits. You've likely seen a peaking in globalization in here, given what we've seen from a political standpoint most recently and the tariffs. We do think that in some respects the U.S. continues to spend at a pace that's unsustainable at some point as far as the ability to keep the dollar really strong. Demographics, not only in the developed world but also in China, continue to economies are getting older, populations are getting older in here, and we do think that can be inflationary. And finally, the deficits continue to be a big issue, not only in the U.S. but certainly now in Europe and other parts of the world as well. So to me, when I look at the dollar, I think the move lower in the dollar earlier this year was a little bit of a signal that there was some weakness. I think that's cyclical. And you've also got some economies in the EM space that when you look at their fiscal situation, they've actually improved. So some of the emerging markets around the world have actually gotten their houses in order from a fiscal standpoint, while developed countries continue to spend at a very aggressive pace. So I don't think it was a surprise to see the dollar take a little bit of a step back on a cyclical basis. On a structural basis, I do still think that there's some reasons why we could see some continued dollar weakness in here.
Thank you. Do you agree, Manisha?
Sure. Yes, we would be relatively in line with that. So a few things. One is that we do think that the dollar weakness is sustainable in nature for a few reasons. One is that, if you think about just what held up the dollar was a lot of, first of all, high carry in terms of rates, and then U.S. exceptionalism, both of which are unwinding. And so some of the draw to invest in the U.S., we think, relative to the rest of the world, is waning. And so there are some reasons for that as we see, international growth outpace U.S. growth. I think the other thing we'd say is that this is probably still the early innings, even if you have seen a 10% decline in the dollar this year. When you look on a historical basis, it really is, in our view, much more of a blip, and so there is more sustainability on that front. When we speak with international investors, one thing that has been coming up a lot has been their continued interest in U.S. equities, not necessarily my market that I spend a ton of time in, but continued interest in U.S. equities. And for a long time, they didn't have to hedge that exposure, right? It was the right trade to not necessarily be hedged. And now, if you think about the U.S. maybe losing its status as a trusted partner, the policy volatility that's stemming here, it's prudent risk management to actually hedge, at least partly, some of your U.S. equity exposure. So we do have a view that you could see continued investments in the U.S. equity space, but that doesn't necessarily mean that means that's going to be a dollar trade. It's really more hedging in our view. In terms of structural, I think just to add another perspective on that, we don't necessarily think that the dollar would lose its reserve currency status. So that's one point I do want to emphasize. The dollar is still the most liquid, the deepest market in terms of trade. And so even if its percentage of usage declines over time, there really, in our view, is no other significant replacement.
Kristen, what do you think?
I would agree with what's already been said. I guess I would just add in terms of valuation, the dollar strength and weakness tends to go in 7 to 8 year cycles. We've had a 10-year cycle of dollar strength. So I just think from a valuation perspective, you really are overdue for a correction in terms of sort of structural dollar weakness in terms of how it's acted in the past. I'd say that, just to reiterate on Anisha's point about the hedging, if you look at a graph of how much international investors own of U.S. equities, it's gone up tremendously. And you can argue part of that is from valuations, but it's also been flows. And then you also map on that chart the hedging ratio, and the hedging ratio has gone down pretty dramatically. So if you have a change either in allocation or in hedging ratios, that can be a significant driver of the dollar going forward too, in a more structural sense. I think there was a couple of things this year that were a little bit more cyclical. One of them was just interest rate differentials between the U.S. and Europe, for instance, and with Europe pretty much being done, the ECB is pretty much done with its cutting cycle. The Fed is continuing to cut. And you also have expected growth differentials for the first time in a long time. People are getting excited about what might happen in Europe, especially with Germany's fiscal stimulus plan. So you have the U.S. slowing, people a little bit more optimistic about Europe. That, I think, is a little bit more cyclical, and a lot of this will be determined, too, with what happens in the U.S. with the AI spend out and how that plays out in terms of growth.
Thank you. Follow-up for you, Kristen. Do you see EM local currency assets benefiting sustainably from some of the things that Anisha, Brian, and you have mentioned, or do you feel like it's more of a short-lived trade?
Well, I think EM local has been a tough trade since 2012, and so it has, it's been dragged down by that dollar strength and the unexpected just length of that dollar strengthening cycle that we've seen. So I think with regard to EM local, we like the EM local trade for many different reasons. The first is just these structural things that both Brian and Anisha mentioned with the U.S. in terms of twin deficits, both on the fiscal side and on the current account side, potentially being a structural problem for the U.S. as compared to EM countries that many of them are improving on those fronts. Certainly on the current account front, fiscal front as well, but that's a little bit more country specific. I think overall, you've got on the U.S. side some things that are weighing it down, but on the EM side, fundamentals are looking very good. If you look at how EM central banks have managed this inflation cycle, they hiked preemptively ahead of the Fed, which typically never happens, so they were very proactive. And then in the cutting cycle, they have been pretty prudent and trying not to make a policy mistake as they've been cutting. And so EM central banks have more room to cut. They are, I think, have been better over time at being inflation targeters and being more responsible and have matured. So we have a situation where real rates in emerging markets are quite high. There's room to cut. They've done a great job at controlling inflation. Valuations are there from the rate side. And then on the FX side, I think that EM versus DM growth looks good, and you have valuations that also are attractive. So I think we could be in for a period of time here where EM local should be a strategic part of portfolios, and we're seeing a lot more interest now, particularly in blended portfolios, letting the portfolio manager choose between dollar and local and what is the best timing for that. But certainly, it does seem like a time where you could have more of a strategic allocation to EM local.
Thank you. Anything that Brian or Anisha agree or disagree on that?
Sure. I mean, Kristen covered a good amount of the core story on EM local. So, EM local currency is up around 17% or so this year. And I think, one of the misnomers about the asset class is that that's actually a primarily investment grade rated asset class with there are frontier market economies and some high yield ones. So, just to pick up off of what Kristen said, there's a dollar story, dollar weakness story. There's a disinflation story as well, allowing EM central banks to cut. And, if you think about EM central banks, two things. One is that they don't have the time to allow for transitory inflation, right? They have to, if they see inflation going up, they have to start to cut. But what are they worried about is currency weakness. So some of the dollar weakness that we've seen gives them that room to cut. And then the third thing I just add is just the fiscal situation, right? So Germany going through such a significant fiscal impulse should have spillover effects into Central and Eastern Europe. We're monitoring what China and Japan may do in terms of additional fiscal stimulus, but that should have additional impact in terms of the Asian economies as well. So we are pretty constructive on the EM local story. It's a wide universe with, again, high quality currencies that actually present in-line volatility with developed market currencies to frontier economies that are less correlated with the overall market.
Thank you. Brian, question for you on inflation and positioning. So I know core inflation, Anisha talked a little bit about inflation as well, and core PCE has been around 3%. Inflation has been a little bit sticky. So given this backdrop, how are you managing exposure, duration, and yield curve, and then how are you thinking about it?
Yeah, we actually we went a little bit shorter duration on a relative basis versus our indexes in June. And really thinking that, we saw this again last year. We saw the Fed start to cut. The market moved really quickly. They priced in almost 10 rate cuts, terminal rate of 3%, and we ended up getting 100 basis points in 24. We saw the same thing start again this year. Fed starts to cut. Jackson Hole changing messaging. We've gotten 2 rate cuts so far. Terminal rate at 3%, and all of a sudden yesterday, maybe we have like a full stop and it's time for a pause. And so we've seen this a couple of different times right now where, the market gets really ahead of itself, and this has gone on for quite a while. And I just think this market, participants in this market are not used to inflation. Inflation is not usually transitory. And we saw that coming out of COVID. We probably are seeing it again here. I don't believe that all the inflation that we're seeing is just due to tariffs. There are other reasons, and I go back to those 4 Ds, those structural themes that we think about in here right now. So I find it a little bit curious that the Fed is focused on jobs at this point and not on inflation. So we think inflation remains sticky in here. You've likely seen maybe a little bit of a lull in U.S. growth that's going to maybe start to pick up here. We do have a scenario where you see something of a productivity boom out here going forward. Maybe not the most highest probability scenario, but it is a non-zero probability in there for sure. So we've gone a little bit short. We do think inflation remains sticky both on a secular basis, but also on a cyclical basis as well, just given the backdrop. Again, globally, EM countries are growing, the U.S. is growing, China seems to be picking up speed as well here. So again, I'm curious that we are seeing the Fed thinking about cutting rates and really falling back just on jobs when inflation is hovering around 2.9, 3.0 on the PCE side.
Would you like to comment, Kristen?
I think with regard to just how we're positioning more broadly, if that's sort of the question here, and I'd say that with regard to upside downside risks on inflation, and on the EM side of things, I think it's a more clear-cut picture that tariff risks and some of the things that we're seeing is potentially inflationary in the U.S. are not inflationary in EM. And I think that's because you've got a situation where China is offloading. They are exporting in order to meet their growth goals because the domestic economy is in such difficult shape. So you have a sort of a different picture in EM, where, as I mentioned before, inflation's very much under control. For the first time, you have shocks, macro shocks like tariffs, which are happening within the confines of appreciating currencies. So you don't have central banks needing to hike in order to deal with some of the potential inflationary impacts. So we're seeing inflation across the board in EM as being relatively contained. I think in the U.S., our economics team still feels that you have, from tariffs, more of a risk to the growth side than to the inflation side. So we're a little less concerned about inflation in the U.S. than maybe Brian's view. But certainly globally, we feel outside the U.S. that we're not in an inflationary type of risk right now.
Thank you. Anisha, how are you thinking about allocating spread risk either with sovereigns, corporates, or securitized within the framework that Kristen and Brian talked about?
Sure, and just to give some background, so TCW is a value-based investor, and so it's a core part of the investment process. So when spreads are widening, we're typically adding risk into volatility and vice versa. And so, maybe I'll just pick up on the duration side too, but on the duration front, we've actually had a more cautious view on certain economies like the U.S. and the U.K. And so we were longer duration earlier in the year. And as rates have come down, we've shaved off that duration, but still maintaining a moderate overweight with the idea that weaker growth feeds into inflation and feeds into weaker consumption than lower inflation. Then, tying that in, that cautious view from a spread perspective, overall, we're overweight spread duration, but it's bifurcated in the sense that we're underweight credit. I think we all, credit spreads are effectively at the tights. IG credit spreads are at the 5th percentile relative to history. So that means 95% of the time they've been wider. And so we've been underweight on the credit side, but overweight on the securitized side, where we're seeing opportunities across agency MBS, non-agency CMBS, and ABS. So that's how we're at a high level positioned.
Thank you. Follow-up for all of you. Do you see specific idiosyncratic opportunities in particular sectors that you're especially excited about?
Yeah, I'd go back to the non-dollar piece right now, and certainly that was an opportunity that we took advantage of earlier in the year and added to an allocation there. I don't know that we're looking for the same amount of appreciation for the rest of this year, but I do think one of the strategies we put in place earlier this year that's paid off as well is there are countries out there that just offer a ton of yield. And we think that there's some fairly steady currency profiles. South Africa is a really good example of that right now, where you just have all things going for them. We actually are getting a little bit of currency appreciation, but it's really more of a yield play for us. So the income side is really important. As far as idiosyncratic and credit, there's still, we work off of 6 pillars of investing. One of them is rising stars. You do still have some opportunities up there for upgrades from high yield into investment grade. I'd look at something like Carnival Cruise. I would look at Teva. I'd look at Rocket Mortgage for some names there. Certainly, we wanted to reduce some of our credit risk, but we're not a manager that's going to completely de-risk the portfolio. We're always going to be leaning into risk throughout the cycle and taking advantage of those opportunities when they come if we do have a little bit of a disruption. So those rising stars are playing a larger role in our high yield portfolio in here right now. Given that high yield valuations are not very good, you don't want to be adding beta, but we do think there's some fundamentally improving stories out there. I agree with Anisha on the securitized side. There is definitely some opportunities there. The diversification that you've seen in ABS the last 5 years, fiber transactions, data centers, aircraft leasing, whole business securitization, all things that are really not correlated with the consumer. And so you're getting away from the idea that the ABS market is just a personal consumer loan market or a subprime auto or credit card receivables market. And so that's broadened out the opportunity set. That piece of the ABS market that's not consumer correlated right now is 40% of the overall ABS market right now. So it's a big opportunity for us in there right now. As far as the credit piece, we don't necessarily think that spreads are a great indicator of value in the market. We would look at a concept called risk premiums. So let's take today's IG spread, call it 75 basis points. We would then subtract what we think are going to be the losses from downgrades into high yield from that space. And that leaves you with the premium that you're getting paid right now. It's not the most attractive that it's ever been, but the fundamentals and the profitability in the investment grade credit market are still pretty good in here right now. And you win in fixed income by collecting income, by just avoiding the losers, whether that's in high yield by avoiding defaults or avoiding anything that comes down to high yield from investment grade. So just keep collecting that income. 80 to 90% of your return over time in fixed portfolios is going to come from income, not from picking the point of entry when spreads you think look cheap. So we do think that the fundamentals and the item selection, the idiosyncratic is really important in credit right now. But we do still think that the income is worth owning given the profitability backdrop and the really good balance sheets that corporate credits have right now.
Thank you. Anything to add? Anisha or Kristen?
Sure. So we're in line on the securitized side, I would say, as well. So on the ABS side, really looking at those opportunities that are less correlated to the consumer. And so you mentioned data centers, for example. I think we're in line in terms of the durable yield, right? You want to really collect that, and you want to have resilience in the portfolio. So when I mentioned we're underweight on the credit side, we're not giving up carry. We're actually still out carrying the index, but we're really selective about where we're invested on the credit side. So even with non-cyclicals in the portfolio, there's some takeout opportunities in there as well. There's some AI-related utilities exposure too. So we do think you can find these idiosyncratic opportunities. On the EM side, Kristen mentioned Argentina earlier. We're finding a significant amount of opportunities. And so even though spreads have compressed, in our EM portfolios, we're still moderately overweight high yield relative to investment grade. And a lot of this is what Kristen mentioned, and I'll stop after this and I'll turn it over to you, but is this improvement in credit quality and the improvement in EM, just from a fundamental perspective on the macro side, from the sovereign perspective, as well as just corporate balance sheets being quite healthy and differentiated from U.S. corporates.
Thank you.
Yeah, I think I'll just pick up on that. I think what you had happen in the credit cycle in EM is that with COVID, you had a number of countries that were smaller countries who lost access to international capital markets at the same time as they need to fiscal stimulus, and it resulted in a number of defaults of smaller countries that then needed to restructure. And so we've really been sort of dragged down, I think, as an asset class by this default restructuring process, and then got hit again with the Russia-Ukraine war in 2022. But over the past couple of years, you've seen the upgrade to downgrade ratio in credit in EM really improve. And so I think that signals sort of a coming out of that more difficult credit cycle for emerging markets. So we also are overweight in our portfolios high yield as opposed to investment grade. Investment grade spreads are quite tight. I'd say as a firm, we're comfortable with duration, and we are, similar to what Anisha mentioned, overweight credit, but slightly lower beta just given the rally and given where valuations are. So with that leaves us in EM portfolios overweight duration, but taking that duration through local because we really like local rates and feel like there's room for central banks to cut rates and for those very high real yield types of economies to reduce their real yields. So we have that local overweight, we have the overweight to high yield on the credit side, and there are some idiosyncratic opportunities. And for us, we like to stick with idiosyncratic opportunities in countries that we think are reforming or have the political ability to make economic reforms. And so I would list Nigeria, potentially Argentina, Ecuador, Sri Lanka, Ghana. There's Ivory Coast. There's a lot of them that now have sort of the political stability to enact some of these economic reforms.
Thank you. So, Anisha, very quickly, looking at the next 12 months, what is one tail risk that keeps you up at night and why? And we'll do this rapid fire so we can keep moving. So go ahead.
So
no
one-word
pressure.
answer. There are many. I mean, we could certainly throw out trade uncertainty if you want a quick one.
I'd say two. I would say the independence of the Fed and just underwriting in areas like private credit and bank loans.
I would just say that there's so many things about China right now that are uncertain. Some of them could go in a more favorable way to risk markets. For example, China has not done fiscal stimulus. Maybe they will change their mind. That's very hard to predict. But, on the trade uncertainty side, they have really pulled out the big guns on rare earths, and they put it back today. But, we'll have to see how that unfolds.
Thank you. Staying with you, Kristen. Now we're going to go in deeper dive a little bit. So does anyone remember what the surprise was that Kristen mentioned? Okay, Kristen, take it away.
Well, let me remind you.
No, I think people remember. They're probably just hesitant to say.
The reason why I say that it was a huge surprise, but I think there was, if you're looking at political pundits or you're looking at polls, this is not unusual. This seems to have been happening more frequently, where you hear, oh, this was such a tail risk. No one was talking about, the potential of XYZ winning in this type of manner. And so I think the expectations were going into these congressional elections in the midterms for Argentina was that, Milei had at best maybe a chance to win 35%, for his party to win 35% of the Congress, and he did much, much better. And I think that just illustrates a couple of things. It illustrates how difficult it is sometimes to predict political risk in all countries in terms of polling and so on, and so you really have to be ready for many different types of outcomes. I think it illustrates just the fact that the U.S. administration is far more active in Latin America than I have any memory of, and I've been doing this for a long time. So we have seen U.S. Intervention, obviously, in Venezuela, in the slapping of exports onto Brazil, here in this case in Argentina. We're seeing it in Colombia. I could go on. And you're never quite sure how that's going to resonate with the local population, because in Brazil, it really, the polls went up for Lula once he was, coming down hard on Bolsonaro. We thought, maybe the same thing will happen in Argentina, and this will actually be backfiring his support for Milei, and it went the other way. So I guess I'm just raising the fact that we've got some new dynamics right now that are very interesting and make it a little bit more challenging in terms of trying to figure out how to position.
And what should investors take away from that, Kristen? So it's surprising, but what?
I think just just recognizing the political and geopolitical risks that we have right now, and just being cognizant of that as they're investing, because again, I think you have to have the political stability and basis for the reforms that can happen in any country, and so getting the politics right is very important.
Thank you. That's very insightful. Anisha, you talked about inflation resilience. What stood out for you in that? Why did you pick that?
Sure. I touched on two. One being just how inflation, in our view, has been relatively calm in the face of tariffs, and part of that is what our credit team is telling us in terms of companies really bearing the costs. It's hard to raise prices, lower prices, raise prices again, right? That's not really part of the business plan for a company. And so, part of that been passed through to the consumer? Sure, but not necessarily entirely yet. So we are looking to see if there's going to be a one-off price shock potentially. And then just more broadly, I think, in terms of questions that we're getting a lot on is the resilience of EM. And so I know we're going to talk about that a little bit later, but if you look at that first week of Liberation, the Liberation Day period, EM credit outperformed U.S. credit. So EM spreads widened, sure, in both markets, but EM high yield spreads widened about 60 basis points. U.S. high yield spreads widened about 90 basis points. So the market, in our view, was pricing in more credit and default risk in the U.S. relative to EM, which you wouldn't necessarily expect or predict in that environment. So that's one that I think is just, again, there are misnomers about the asset class that provide a lot of opportunity for all of us.
Thank you. Brian, you talked a little bit about your surprise, the job reports, and so can you?
Yeah, I think to start off with the conclusion, you may not need as many jobs as you think to maintain the unemployment rate, and I think there's four factors that are in there that has led to some of the job weakness that we've seen. Certainly, the cutback in government, AI, tariffs, but I think the big one is immigration. And we're going from a period of time where maybe you're going to import 3 million people into this country to maybe 500,000. And so if that's the case and your participation rate is not going to be going down because of all the influx of people coming into the country, you don't need more than 40, 50, 60,000 jobs to create a month to maintain that unemployment rate. So I find it a little surprising that when the last couple of months we've seen some numbers that were lower, and even that ADP survey that came out earlier this week, that if you extrapolate that out to 4 weeks, it's in the 50 to 60,000 job gain range. That the market continues to think that the Fed's going to go to 3% on Fed funds here because of some job weakness, when in reality, maybe you don't need to create as many jobs as we have in the past because immigration has been cut back so much, and some of those other factors, government, AI, and tariffs as well. So tariff uncertainty leading to people not hiring, AI. I was telling Anisha earlier, I was at a conference a week or two ago, and a guy who spoke was the head of robotics at Morgan Stanley and said there were 5 humans for every 1 robot in the fulfillment centers at Amazon a few years ago. It was 2 to 1 last year, and he says within the next 3 years it will flip. There will be more robots than people. So I think there's some factors out there that may lead to some to slower job growth. That doesn't necessarily mean the economy's weak. It may just mean that we're not importing as many people as we have in the past.
Thank you. Let's switch now to what a core fixed income portfolio looks like. And Anisha talked about TCW being a fixed income shop predominantly. So global allocators are now rethinking what core, and others as well, are rethinking what core fixed income means. So how are you thinking about what core means, what core plus is, and what is opportunistic?
Sure. I mean, in our core plus and our global ag strategies, we've always looked at the broadest opportunity set, so we haven't necessarily limited to what's in the benchmark. You know, Brian talked a lot about securitized. A lot of the securitized is actually not even in the index, right? So we have to look at a broader spectrum to capitalize on all the various opportunities. I'd go back to just what I mentioned earlier in terms of, finding opportunities in the credit space while being underweight from a spread duration perspective, and then finding these interesting opportunities on the securitized side. Again, agency MBS, non-agency MBS. In the CMBS space, looking at some single asset, single borrowers, where you basically we're looking at the high quality trophy assets, these office properties that basically have high tenancy and are in major cities. And then, even just, given some of our view in terms of capital preservation, CLOs can also, if you look at just AAA, AA CLOs, you can find really some interesting opportunities there that help mitigate during a downturn. I think the other thing, and then on the EM side too, certainly that's an area of focus as well in terms of adding alpha to a portfolio. EM, I think we can all argue, again, credit spreads are tight, but, we talk about this a lot internally in terms of, okay, so you're a U.S. corporate, let's say 75, 85 basis points, and then you're a high quality EM, investment grade sovereign, at a similar or to wider spread. Would you rather be in a high quality sovereign that's probably not going anywhere versus a corporate that might be facing pressures, tariff pressures, pricing pressures, et cetera? So we think there's a trade there. But in aggregate, as I mentioned, overweight duration, less so than at the beginning of the year, overweight securitized, and underweight credit.
Thank you. Brian, anything you'd add?
Yeah, I think we're very much aligned on the securitized again, CLOs, et cetera. I think when I think about Core Plus today, some of the things that we're incorporating, and I know we're going to talk about this a little bit, but we're starting to incorporate some private credit into this as well, particularly on the investment grade side. So the target is to find deals, and it's infrastructure and structured credit for the most part, that add 100 to 150 basis points over publics into the portfolio. And I was the first bank loan trader at Loomis about 25 years ago. And back before I started trading them, we did had a little history lesson on that. But bank loans were great back in the 90s because there was no volatility. Well, the reason there was no volatility is because nothing ever traded. And so the private credit market does remind me of that in some respects today, where you're not seeing a lot of volatility because a lot of it's not trading. But it's coming, and it's coming quickly. And so the convergence of the public and private markets is, and so that's something that we're doing in the portfolios that I think when you think about Core Plus, you really have to incorporate that. And similar to Anisha, we're getting benchmarked against the ag. I have no idea what's in the ag. We don't look at it. I don't look at it at all. It's like, I don't want to look like the ag. If you want to beat the benchmark, you can't look like the benchmark is what we want to look at. So we want to look at just a basket of best ideas across a number of sectors of the market and really understand what's a company worth, what's a company valued at, to really understand what you should get paid for that. So I'll stop.
Kristen, do you think EM plays a bigger role in Core and Core Plus? What's your view?
Well, I think that 20 years ago, Core Plus portfolios would use EM tactically, and that was the main use for us in the firm of EM, really was to sort of be a tactical adjunct to a core portfolio or be used in a Core Plus portfolio. I just think EM is changed substantially over the last 15 years and has become just much more of a strategic asset class instead of just being used tactically. And to Brian's point earlier on the power of coupon and income, if you look at dollar pay emerging markets, 95% of the overall total return over the last 20 years has been from clipping that income and that coupon. And so you're just paid to hold it. It's very hard to trade in and out of it successfully, I think. And I think for a number of reasons, that plus just the fact that you can really diversify outside of the US, that EM countries are going to be growing faster than DM countries. There's a whole host of reasons why you'd want to have EM be sort of a strategic part of a portfolio, and that's what both U.S. and international institutions have done over the past 15 years, is to make it a much more strategic part of the portfolio. And I think we're just going to continue to see that, and it may change in terms of adding local to be a bigger part of that strategic allocation, but that's, I think, the direction of travel.
Can I add just one more thing on this? So if I thought about just the yield curve and the experience we've all had in the last 40 years, in Core Plus, you could look like the ag, right? Because interest rates were declining forever. And we've gotten to the point where they got about as low as they could go, and now they've started to come back. And so in Core Plus, sort of the median tracking error has always kind of been right around 200 basis points. And for that period of time when interest rates were declining, those who had less tracking error to the ag typically were the winners. They were the best performers. What you've seen in the last 10 to 15 years is that the median tracking error in Core Plus is still 200 basis points, but it's the managers who don't look like the ag anymore, who have a higher tracking error now, that are the top decile performers in Core Plus. So you can't look like the ag in an environment where interest rates are potentially going up. You have to look different, and you have to think about it as far as being flexible and buying into different sectors of the market.
And can I jump in as well? Well, Brian brought up a really good point in terms of adding private credit to Core Plus portfolios, and you're seeing that trend in the market. There was Core Plus, now there's Core Plus Plus, right? And part of that is the valuations. And so in some of our portfolios, we've been adding some ABF or just looking at the investment grade spectrum overall, because these are still high quality issuers. Credit is credit, securitized is securitized. You're lending to these companies just via a different method, right? So I do think you're going to continue to see, and you've seen it in the market, this proliferation of how do we access high quality exposure through multiple vehicles.
Thank you. Since we're on this topic, let's talk a little bit about EM corporates and local markets. So with more institutional money entering EM, are you seeing any crowding? And for active managers, such as the companies here, does that change your opportunity set?
I'd say, are you speaking for EM corporates? I have not seen crowding in the EM corporate space. That's not something that we're worried about right now. I think definitely this year we've seen more crossover interest in emerging markets in general, including EM corporates, than we've seen in the previous few years. And as I mentioned, that period of sort of COVID and Russia-Ukraine till now, crossover investment was not as high as it is today. But then if you look back the last 10 years, I'd say today's crossover investment is on a sort of historical average. So I'm not worried about crowding. I think in the EM corporate space, in terms of the universe of opportunity or the opportunity set that you have, it's just gotten so much larger over the last 10 years. I mean, it used to be primarily oil and gas and finance. It used to be primarily Latin America, Asia. And now you have, it's a $1.2 trillion asset class. So it's huge. Every sector is represented. There's over 60-something countries that issue EM corporates. And it's a triple B minus overall quality. So it allows you to, we have a lot of insurance clients, for instance, that really just want to focus on investment grade EM corporates, and they're able to do that. So I'd just say the universe, that opportunity set has expanded and broadened so much that, we have a lot of opportunities without feeling crowded.
Do you see dispersion, or a lot of dispersion in the names you're looking at?
In terms of performance, or?
Yes.
Yes, I think with an asset class that's over 750 issuers that you're going to see a lot of dispersion. And this year, certainly, every year there's going to be pain points. And so we saw that play out with defaults in the Russia-Ukraine space, and then in the China property space. This year, Brazil has been more challenged, especially names like Braskem in the petrochem sector. So yes, I think there's always going to be a lot of dispersion in returns.
Thank you. What are you seeing from your?
Yeah, we would agree with Kristen. We're not necessarily seeing crowding in the EM corporate market, and we're seeing certainly opportunity. So, as Kristen mentioned, it's a broad universe. There are now over 750 companies, and the important point is really what are the fundamentals. And EM corporate leverage is at effectively decade lows. And if you look at that versus U.S. corporate leverage, there's a significant difference between the two. And so that's the value, right? You're getting paid more in terms of spread, but you also are there's less units of leverage that you're also across every single ratings category. So we're not necessarily seeing crowding in that space. I think what is going to be interesting, though, and we touched on this a little bit, is actually private credit in emerging markets. We're going to talk about, I think, convergence later, but EM private credit is a market of 180 to 200 billion, so not that big, right? When you think about the 3 trillion or so that's in private credit overall. And so we're certainly monitoring that because we're starting to see more opportunities in the private space. And so to us, that gives issuers just more options, right? But it also, for us, could give us more opportunities, as Brian has talked about, income, right? So higher income. And if you know these credits, I think we're probably, there's a lot of diligence that has to go into underwriting and lending to these companies. If you know these credits and you can get paid more, there is an opportunity there. So that's something that we are evaluating as we think about just the next stage of EM corporates.
Thank you. That's a great segue, Anisha, into our next question on private and public markets. So are you seeing convergence since a lot of funds are flowing into similar collateral pools?
Sure. I mean, I think, look, the lines are blurring between private and public, right? You're lending to a company and they have multiple options and they're optimizing, right? They're optimizing their capital structure. So it's not surprising to see this, and it's, in our view, likely to continue. I was at a conference recently where a CIO mentioned how, in 5 years, there's not going to be public or private credit. There's not going to be public or private equity. It's just going to be equity and fixed income. So we can all talk about some of the risks that that have emerged recently in the private credit markets, but that really to us just emphasizes how important manager selection is. And so are there certain deals that larger sponsor deals that maybe that's not the market that we're in, but that maybe you're going to see less return potential because more people are going after the same kind of market? Sure, that is something that we do think that we're going to see. Are there risks around some covenant light structures? Yes, but overall, we are seeing the blurring of those lines and would anticipate more convergence over time.
Brian, you talked about it a little bit earlier.
Yeah, so I would just use Meta as the most recent example, right? So Meta goes out and does $26 billion, quasi-private market 2 weeks ago. They're working on the deal for a year and a half. At the end, they added the big buyer of that, I'm not going to mention, added a 144A caveat to that so that it can trade in the marketplace, and that is actually trading. So that's $26 billion, quasi-private. Meta's in the market today, in the public market's doing $25 billion. So that's $51 billion in the last 2 to 3 weeks that a large issuer has done in two different markets. So I think the issuers are going to want to have issuance, and they're going to want to have their foot in every one of these markets. They can play them off against each other for the best metrics that they can get. What's the best financing we can find? And I think this, like Anisha said, this is in a few years you're not going to know the difference between this. You'll see secondary trading in privates. You're already starting to see electronic trading in bank loans. 20% of the investment grade market in the U.S. right now is done on portfolio trades. So I mean, this is rapidly becoming a more commoditized market in here. So if you're a trader, you don't need as many traders, and it's going to be harder to add value in these markets going forward. But there is a massive convergence happening, and we're in the middle of it right now.
Thank you. I want to switch gears now to securitized. Talk a little bit about securitized. So CLOs have seen a lot of demand recently. It has been very attractive. So what role do you see these playing in a fixed income portfolio that's multi-sector?
Yeah, I think for us, I look at the CLO market and I think about it in terms of what we call a complexity premium. We don't necessarily just have to buy AAA or AA. I think we have the expertise to be able to go down to a single A or even a triple B tranche. Now, granted, you look at it at a triple B or a single A CLO, you look at the volatility, and it's akin to a double B bank loan. So you need to be aware of your position sizing and the amount of volatility that you're adding to your portfolio in here. But you look back in history at the events of default that have actually impacted a triple B or a single A CLO, and it's very, very minor. And so I'm not sure we've seen more than a handful of single A's ever that have had an impairment from a principal standpoint. So to me, it's a nice way to pick up some extra additional yield in the portfolio without a lot of duration at this point in time. So as SOFR continues to go down, it probably becomes a little bit less attractive at this point. But it's $1 trillion market. You've got ETFs now trading CLOs. So it's an established market that's here to stay. I think there's a piece for it in your portfolio. I think when value is better, you want to go down in the credit spectrum. When value is not as evident, you want to be up. We're more up right now, AA, AAA. But there's certainly a time where you should be buying single A and AAA, and even in your more aggressive portfolios, double B CLO tranches, which can be a huge home runs in terms of return in there. But again, you have to get paid for those risks. And again, you have to have the expertise to be able to go down the quality spectrum to really capture that complexity premium.
So do you think investors are being compensated in today's market for that complexity risk?
Yeah, as I said, we're a little bit higher in quality right now. So I think there's been some compression along the stack as far as ratings are concerned. So we're a little bit more cautious about going down in there, into those lower rated tranches right now. So you're probably not getting compensated as much as you would in the past. So we're more content to be in those higher quality tranches right now.
Thank you. This has been a fantastic conversation. I want to leave time for audience questions. But before we do that, rapid fire again, starting with you, Kristen. What's one key takeaway that you'd like the audience to leave with today?
I think that I'd just say that when it comes to what we're thinking about the dollar, that this could be a structural trade. So think about what that means in potentially a strategic way in the portfolio.
This is a different secular environment, we think, and you have to think differently. Flexibility is going to win. Item selection wins out right now.
Yeah, I would pick up off both of that, right? Bottom-up security selection is key, right? Rigorous diligence of these credits, and you can really, I think, the opportunity set is so broad that you can still find a good amount of opportunities.
Thank you. We'll open it up to audience questions. I see some people, but or maybe not.
Anisha, you touched a little bit on the attractiveness of legacy and agency mortgage-backed securities. And I mean, when you look at the space, you know, you do have spreads that are in more of that 50 to 60th percentile, decent all-in yields, fundamentally low LTVs, really low CPRs being priced in. And then technically, you know, you have some of those demand dynamics from banks actually coming back in, and you actually have an administration too that's really incentivized to get mortgage spreads down. And so you kind of look at it, it's like, I have my cake and I'm eating it too. But I think on the other side of it, you need to think like, what could go wrong from here? Like, what is the other side of that view? So I was wondering if you have some views on the, you know, pros and cons right now.
Yeah, I mean, I think on the agency, and Brian, you may want to pick up on this, but on the agency MBS side, so if you look at the current coupon, it's around 120 basis points. So to your point, you know, if you look at securitized overall, you're kind of in that 50th or so, give or take, percentile relative to history. And so where we've been positioned has been more in, not necessarily in the current coupon, but lower coupon to protect a little bit and capture the price appreciation, because there is rate volatility, right? There is sensitivity to rates in those structures. And so that's how we haven't really been as focused on, let's say, the current, but it's much more focused on the view in terms of growth slowing, the Fed cutting rates, and then starting to see prepayments pick up again. To your point about the banks starting to buy more and being more incentivized as you see that vol go down. Now, if we're in a different environment, right, in terms of higher inflation, rate rises, et cetera, that's a little bit, that's some of the risk. Brian, you might want to pick up.
I'm watching, it's slow moving, see if it actually happens, but if they're actually going to make a move with Fannie and Freddie, I think that's something. It's a tail risk. It's something to watch, though, for sure. We were in the other room at lunch just listening to the rebuilding of LA, and one of the things that stood out to me, and it stood out to me for almost 15 since the GFC, is the financing that's gotten taken away from the small builders since '08 that's never come back. And so I look at supply, and I don't see supply as a risk in this market right now, largely because of that. Part of it's affordability too, labor supply, and materials and land costs. It's hard to build starter homes right now, along with the financing too. So it's an affordability issue. I don't know how you change that without changing local zoning laws to create more lots and incent builders to do something. So it's probably a nice place to hide at this point. I am keeping an eye on what's going on with Fannie and Freddie though, because that could be a very different dynamic if that happens.
Cool, thank you.
Yeah.
Thank you for the question.
Another question that comes up, did someone have a question? Okay, another question that comes up, and when I was talking to people, was just about the U.S. dominance and how the deficit, you talked about this a little bit earlier, is playing into it, your outlook for the markets. So how are you thinking about it, and what are you doing to position your portfolios?
I think structural deficits are a risk for the long end of the curve. We've been underweight key rate durations in the long end for quite some time. I think if there's an easing of the SLR for the banks are going to end up buying more. We can go down a rabbit hole and talk about Fed independence, but there's a scenario where if Cook gets removed from the board, Bostic gets removed from the board, and we have a loyalist as your Fed chairman. By the way, whoever gets this out of the five, or Besant, whoever gets the position, we think he's going to take Myron's spot, and then when the chairman piece comes up, that person will be named chairman, and then he'll fill another spot there. So you could see a scenario, and this is again a tail risk, but yield curve control in the long end, bringing rates down. Monetary policy is no longer the primary use of the Fed. It's now fiscal policy. They're trying to refinance 25% of the debt every year right now. And so lower rates would really be an incentive to do that. So I think that's, when I think about structural deficits and how the long end would react to something like that, I think you could see a pretty significant steepening of the curve. For a while, people talk about bond vigilantes. The bond vigilantes show up and they win until the financial repressionists are in the room. And when they show up, then the flight to quality and the correlations go back to one. But for a while, the bond vigilantes will rule.
Thank you. Kristen, can you talk a little bit about your approach to local EF markets and how Payden is thinking about strategic allocation?
I think that back in sort of that 2012 to 14 period, after a period of dollar weakness, EM local gained a lot of traction with consultants, and it was many consultants were saying EM local only portfolios. I think the way that most people are thinking about EM local now is to do it most likely through a blend, unless you're a very large manager and you want to set your own strategic asset allocation, but to think, to have it as part of the benchmark, but to have it in a blend where the manager can look at a country and think, how do I best want to express a view if I like a country? Do I think I want to be in dollar, local, or corporate? What's my expected total return versus volatility over the next 6 months for these various asset classes? So I'd say, we would say that a smart way to do it is a bit more holistically, to include it as a strategic part of a benchmark, but potentially in a more blended type of fashion where you allow the manager that flexibility. I'd say within local portfolios or the local part of portfolios, we have tended to be more focused on Latin America, where we think real yields are higher, where we think a number of countries have the ability to continue to cut rates, whether it's Mexico or Peru, whether high real yields in Brazil, for instance. And Latin America is also a region which has not suffered very much from tariffs for the most part, as compared to Asia, for instance. And then Asia, rates are just a lot lower, and their currencies are a little bit more tied to what happens in China, and whether China allows their currency to appreciate. So I'd say within EM local, we like Latin America over Asia. Within CEMEA, we like South Africa. I know you mentioned that, where they're, I think, benefiting from better terms of trade, where they're importing energy and they're exporting gold, and doing a better job at inflation targeting. And then you have your sort of frontier markets too, which are interesting, whether it be Nigeria or Egypt, where you're really getting paid to take some sort of non-correlated risk to the rest of the currency markets.
Thank you. Anisha and Brian, as you think about securitized, how are you thinking about the underwriting risks in these? How are you looking at vintage? How are you assessing the collateral pool? And is there something different in today's environment than what you've done before?
I mean, it's really about the team. I think that we have, that's really covering both public and private securitized. And so, at TCW, we manage around 80 billion of securitized assets across multiple portfolios. And so there's a combination of proprietary analytics, just a robust team across all the different subsegments, looking globally at opportunities as well. And, we can think about the tricolor situation. And those are things that requires a lot of extensive diligence to ensure what your collateral is. We also stress test the collateral during different economic periods as well. But again, it really comes back to whether you're doing credit or you're doing securitized, is understanding these management teams, understanding how they're going to generate cash flow, and building a durable portfolio.
Yeah, there's some issuers who have been through cycles, and in the subprime markets in particular. First of all, those structures are built to have a period where they have delinquencies, they have defaults. There's over collateralization. There's credit enhancement built into those portfolios. So those structures are built to have that happen, and it's going to happen. But when you get to the end of a cycle, we're in the later stages of an expansion now, you really want to focus on, and maybe a different way of saying what Anisha just said, but let's focus on and let's invest with issuers who have gone through cycles and have seen periods of down performance, and will support their deals. Most of these guys need access to these markets time and again through the cycles, so you don't want to blow up a group of investors by sending them a really bad deal. I would also say right now what we've seen is that lending standards have been risen, and so a lot of lending that's going on is being done to a higher FICO cohort today than maybe what it was 2 or 3 years ago, and I think that's benefited a lot of the issuers as well.
Thank you. Thank you to all the audience for joining, and please join me in thanking Kristen, Brian, and Anisha for a fantastic conversation.